What's up, Mr. Boyer?
Hey, good morning. I know.
How you been?
Good. How you doing?
I'm good, man. I'm excited. Thanks a lot for tuning in with me here.
Thanks for having me.
Well, what we wanted to do is what we're pushing out here is sharing some of the experts that work with us inside the TKE, the Kinetic Experience, out via some of these Facebook Lives to get more interaction, obviously, and get more exposure to what we're working on. So thanks for being part of this.
Yeah, happy to help. Happy to share a little bit and happy to join the community.
That's right. So if you're just now tuning in, you can join via the Zoom link. Of course, you can put your comments on the video there, and I'll grab those. Bryan's got a couple of topics he wants to talk about, and then we've already have some questions that have been submitted that we're going to address, or he's going to address. And please put your comments there, or join us on Zoom, and you can talk to us there. So Bryon, what you got for us today?
So a little unusual today. So this isn't sort of a purely business legal. I figured with it's 2019. It's the beginning of what's called the Tax Cuts and Jobs Act of 2018, the TCJA. So basically the tax laws have all been changed, and it's January, right? 2019. So it's tax season. Kind of wanted to take and do, because, you know, my first and foremost love and specialization is I'm classically trained as a tax lawyer. So I figured we'd take a little bit of time to dig deep a little bit into kind of some heads up rolling into tax season, and we'll gear this towards small business owners and individuals, and also tax preparers and tax professionals. Just a couple of things to watch out for as you're walking into the season.
That's amazing. So let's get started. What you got?
Sure. So the first thing is, if you're watching this, you know, in history, it's January 2019, and the government shut down right now, or at least part of it. And part of that shutdown includes the Treasury Department. If you're unfamiliar how government works, the Treasury Department is a cabinet level department that reports to the president. And there's an agency underneath the Treasury that we all know and love called the Internal Revenue Service. So basically, the tax department of the United States government is shut down right now in the first season of the TCJA, which is drafted incorrectly. Congress will readily admit to you that they goofed the language because they were in a hurry. Well, history of the world, they were in a hurry, so they tried to pass it, rush it through, knowing it was wrong. And then they told the Treasury Department, you fix part of it, and then when we have another election, in which we just did in 2018, we'll do what's called a tax corrections bill. We'll just fix it later after the fact before it hits. Well, we've got a divided government right now, so it's not likely that we're going to get a tax corrections bill. And to the extent that the Treasury Department was expected to fix it, they're shut down. And the IRS is furloughed right now. As of us speaking today, they're supposed to be bringing about half the IRS workforce back unpaid to process tax returns. So what are the open questions we have right now, right? So first and foremost, will returns be processed, and will refunds be paid? Now, the administration, the Trump administration, is saying, yes, it's going to happen. They've released notices to the IRS. It's going to happen. They haven't yet released any logistics to prove that it will happen. So, you know, they may be overpromising. We don't know if they'll be able to deliver as of right now, because the season doesn't open until the end of January when they start processing anyway. So they've got some time, but my expectation is that they'll probably end up, say, turning on the government in a week or two, and then telling us, everybody, hey, it's going to be thing. So just be aware of that. The next issue that comes to my mind is, will your returns be timely, and what will be considered timely filing? And what I mean by that is, if and when the government turns back on, are they going to change the due date for 2019 from being April 15th to May 15th, June 15th, right, July 15th? If the timeline for the government moves to the right, are they going to give that same grace to all of us? Or are they going to expect it to have just been filed in the mailroom with nobody checking it, you know, post-dated before April 15th? That's right. Kind of an open question right now. Now, obviously, I'm going to tell you, file it or file an extension, but right. we just don't know.
Now, wouldn't you say that there could be an argument, or most likely the argument will be made, whereas like the IRS was closed during all this time, so we couldn't get question answered, and now you've delayed everything, so let's push everything out going forward? So, and that's a great point. I think no, this is just me. If I knew the future, I wouldn't be on this conversation with you right now. I'd be gambling in Monte Carlo. But I like to think if you knew the future, you'd hang out with me. But keep on going.
I mean, maybe that's a different scenario. But I think what's likely to happen, because there's a lot of problems that need to be addressed unrelated to the government shutdown. I think they're just going to have to show leniency for late and or incorrect filings to a certain extent, because even if the government were open, there were questions that the Treasury Department hasn't answered and that Congress hasn't answered for us that, I mean, technically they could punish us for, but I would say politically it'd be a really bad move to put something out that's gray and punish somebody for using dark gray instead of light gray when you didn't say what gray it was.
That makes sense. Absolutely.
Shameless plug for my alma mater. Anybody else, if you want a shameless plug, give me a coffee cup. I'll use it. I love free coffee cups. So that's the issue. Timeliness of filing. What is going to be the deadline? Right now it hasn't changed, but it could be the problem is this. Maybe the IRS is, top brass have decided already they want to make this 1 year the change May 15th, but they can't come into the office while they're furloughed to send out the notice to say we want to make it May 15th. So they can't even do that until they get back into the office. Yeah,
so what I learned is that they're actually required to stay ready to work, right? I think it's within, you have to show up to work the next day.
I think it's depending on your position, it's between 2 and 24 hours. Some people are expected to be there within 2 hours, provided they didn't already have leave or anything in, right? Like if it was known quantity, you're going to be gone. But if you're at the house, they expect you to be back within 2 to 24 hours, depending on whether or not you can. Now, here's the really interesting question that will blow way off topic. It's potentially violating what's called the Anti-Deficiency Act for the IRS to come in unpaid. So the Anti-Deficiency Act really has to do with government procurement, and it says the government cannot procure something or obligate itself to spend money that Congress hasn't previously appropriated for government unless it's an extreme situation of protecting life or property of the United States. It's an argument to be made that the IRS is protecting the property of the United States, but they're certainly not, you wouldn't confuse them with the military or Border Patrol or air traffic controllers, people that are working now unpaid that you obviously think, yes, their job is essential to protecting life or property. So that's not necessarily going to stop the IRS workers from coming back, but it's a lawsuit that you'll likely see play out over any number of years. But just understand it's one more hang up that will take oxygen from the IRS when they should be telling us how to comply with the new tax law.
All right, that's awesome.
And then
let's go to one of the other.
Yeah, so one more issue with that is what's going to happen with the enforcement division? Are they going to write off a lot of things because they're overworked, or are they just going to have a backlog? And is enforcement going to be up the way it's supposed to be? Because when they passed the TCJA, they instructed the IRS to go get more money. They're basically saying that everybody talking about the amount of revenue lost is assuming that the amount of revenue that they go capture is static. Well, they were told to go capture more, but now they're not here. So sorry, go ahead.
No, that's fine. So while you're here, can you go and list out some of the different deadlines that you know that are very common in the tax world?
Sure. And one of them just changed last year and caught everybody with their pants down, basically. So your individual return is generally due April 15th. Now, some days it might be like the 18th or 15th, April 18th or 19th. If the 15th ends up on a federal holiday or a weekend, it's going to be pushed to usually the next Monday. But generally speaking, assume that it's April 15th, because what it's supposed to be under law is the 15th day of the 4th month.
Okay.
Now, it used to be that partnership returns were due the same time. Until last year, they changed it. So now, S Corps and partnerships, so if you file an 1120S or a 1065, those are due March 15th. And here's why that's really important is for every month that a partnership—
That's like corporate, right?
Yes, exactly. That's exactly right. So basically they've tied so now that there's no difference for business returns. Business returns are due when they're due, right? So any 1120, 1120S or 1065, if you're not a fiscal year taxpayer, if your year ends on 12/31, is due March 15th. The reason that tripped people up is because for every month that a 1065 partnership return was late, and if last year you still thought it was April 15th, you were going to be late at least 1 month. For every month that it's late, there's a $195 per partner penalty. So if you had 10 partners, you'd have a $1,950 penalty per month that it's late, up to 12 months. So pretty substantial. I literally have a client right now whose penalty is about $85,000 just because the filings were late. And the IRS treats that like a speeding ticket. There's no, well, I didn't know it was wrong, so please don't punish me because I wasn't trying to be wrong. They're like, you did it or you didn't. So that's very good information to have, is the due dates. So now moving on to the next thing. And I'm not going to dive into detail about this necessarily because we could spend 28 hours on it. 199A. So if you don't click what that is, that's the vaunted and celebrated 20% deduction for pass-through businesses. Or at least that's what it was sold as. So what that is supposed to be is any business that is not a C Corp for tax purposes gets up to a 20% deduction at the taxpayer level. So, and again, here's where it's weird. The 20% deduction is based on your piece of the business income, not the business income overall. So what I thought it should have said was if your business makes $100,000, then knock 20,000 off the top of that 100,000. But instead what they did is say the business makes whatever the business makes. And if there's two owners, the business gives each owner 50,000 and then that owner can take 20% off of the 50,000 that they each got. So it's a little bit different. So, and here's the problem with it. That's one of the statutes where when Congress whiffed it, this is the one that everybody screams about Congress who really, really did this one poorly. So they came out, the IRS came out with proposed regs, or the Treasury Department, I should say, proposed regs in approximately August of 2018. Proposed, they're not finalized and they can't be finalized right now because again, the IRS isn't there. But you can't be penalized if you follow proposed regs. You theoretically might not be penalized if you don't follow the proposed regs because you can say, I know you guys drafted it this way, but that was a proposal and I think your proposal was wrong and mine's better. But you're never going to get in trouble for following the proposed regs. Well, the proposed regs don't exactly match what the statute says. And regulations, if a statute is the floor, regulations can go above the floor to add more stuff or interpret the floor, but they can never go below the floor. Well, some of these proposed regs seem like they go below the floor. So then the question is, well, am I allowed to follow the proposed reg if I know it violates the face of the statute? Probably not. I mean, at least technically, no. They might not get you in trouble for it because it's their goof up. So that's one thing. And then the IRS came out with, they have what's called pubs or publications that sort of explain in great detail things that go onto forms. And they came up with a draft pub for filling out the worksheets that they've created to comply with this on your tax return, because there's what the law says, and then there's how it goes onto your tax return with special worksheets. Well, the draft pub doesn't match the regs or the statute. So now the question is, well, you told me the regulation says X. You gave me a worksheet that doesn't square with X. Which one am I supposed to do? Do I make my own worksheet? Do I use your worksheet that I know to have flaws in it? I don't know what to do. And here's the biggest takeaway that I'm going to tell people, and I've got a list coming down, but the biggest takeaway that's weird about 199A is everybody assumed that this would make your business tax return more complicated. It doesn't. It doesn't change your business tax return because it's not filed with the business, it's filed with the business owner. So 199A, if you had 7 different businesses, you would have 7 different potential 199A issues for Abe or for Bryon, because it's not what my business did, it's what I did. And now let me run through the list of weird things about it. So one, if you're allowed to, you can aggregate all 7 businesses if you own at least half of them and they all sort of service each other, right? So if I had a real estate business and a real estate remodeling business, I could probably aggregate those 2 businesses and make one net profit or loss for them for this calculation, but not if I didn't own more than half of the businesses. Well, you've got to tell that to your tax preparer, your tax professional, or you've got to tell it to the software you're using. No one's going to know that but you. And that's really different. Usually tax preparers can say, well, this is what you should do, or software will guide you down the road. This is a unique situation where you must tell it what it is and you must be right or wrong, because there's a huge penalty if you calculate this math wrong. So that's one thing that you as the individual have to tell your tax preparer or your software. So understand it and reach out if you don't understand it. There's this thing called go ahead.
No, that makes total sense. So you obviously do you primarily deal with business owners as they interact with their CPA and their bookkeeper? Or because some of the stuff is very technical. And
yes. So both. So I can interact with business owners. What I usually tell business owners is I have the small business and tax planning piece of the house. So how do I save you money on taxes? And how do we make your business work the right way as far as the right entity, the right contracts, the right policies, everything like that? Deal with me on that. for the tax compliance piece, for knowing what nuts and bolts go on what piece of paper for your tax forms, put me in contact with your CPA or your tax professional, and I will let your tax professional hire me as a client, or I will work an engagement where I deal face-to-face with them, because we just speak the same language and I know what inputs they're needing to fill out the forms.
That makes
Because
sense.
a lot of times tax preparers will do it wrong because the client didn't know what to tell them to do. So you need an intermediary to explain it to the CPA or whoever, the tax preparer, to make that light bulb go off to say, oh, wow, of the two forms that are possible here, this is why it should be Form A, not Form B. So specified trades or businesses. And these are basically what we refer to as white-collar service jobs. Lawyers, accountants, doctors, consultants, athletes. They don't get the 20% special deduction unless they make less than $315,000 as a married couple, or $157,500, which is half of that number if they're single. Here's the problem: the proposed regs say it's like doctors, lawyers, accountants, and other things that are similar to that, where your reputation matters. Well, you've got to tell the IRS by checking the box on the form, my business is or is not a specified service, trade, or business, and that makes all the difference in the world for you. But they have an interesting example in the proposed regs. It says, well, what about a celebrity chef who owns restaurants? Those restaurants are clearly not a specified white-collar trade or business. But he also gets endorsement deals from cooking utensils and cookware and gets paid from that. Well, that, because of his name recognition, is a specified trade or business. So now he's got one that is and one that isn't. And it's his responsibility to put on the tax return which one is and which one isn't. Again, this is much more work than a business owner has ever been required to do on their tax return, and a lot more questions that you've got to tell your tax preparer, and it's on the two of you if you made the determination wrong. So a lot more investigating, potentially hiring a tax lawyer to write you a letter saying this is why they believe, because they've got a license to say that, you should be X or Y. So again, the next bullet point I have is, don't be surprised if you have to sit down with your tax preparer and have a lot of discussions about all these unique little nuances, when you used to be able to say, here's my P&L, here's my balance sheet, here's my W-2s and everything else, go away and tell me when my stuff's done. Now you got to sit down and spend some face time. Don't be surprised if that also means that your price goes up a little bit more, because it's a little bit more work than they're used to doing. They're probably used to having you give them the shoebox and calling it a day. The other two quick things I'll go over. Total income is your $315,000. It's not your business income, it's your total income. So if you have a day job and a side hustle and your day job makes a whole bunch of money, you may have turned this off or given it a limitation because of your day job or any number of other sources of income. And that's a little unusual, because that doesn't square with wanting to help you start a business. It shouldn't be based on your income level. It should be based on you're hiring people or something productive to the economy. But be aware that its taxable income is $315,000, not business income. And then rental properties. This is a real huge one.
And is that, one second, is that adjusted income or is that gross?
Taxable income.
Taxable, okay.
So here's what's really weird about 199A. I'm glad you said that. And this is why your tax return is going to go up in value, expense.
Right.
Before I can calculate the 199A calculation, I have to know your taxable income. To know your taxable income, I've got to do an entire tax return 1040 for you, as though 199A didn't exist. Then use that plug number to put back into the 199A calculation to get a new bottom line to go re-put into your 1040 and then run your entire 1040 again. So I've got to do at a bare minimum at least two full tax returns for you to get the numbers to make it work. So again, you may end up paying a lot more because someone's doing double effort than they've ever had to do before.
So, but from a tactical perspective, what does this mean to a CPA? Are they running this in a software that'll just automatically calculate them for them?
I would assume 99% are, but I'm part of some Facebook groups of accountants and tax preparers and EAs who there's an entire Facebook group dedicated to nothing but 199A, and across, let's call it the 10 most popular tax softwares, people are getting different answers depending on what software they use. Part of it is what their inputs are, and part of it is some of these softwares are probably calculating it wrong. And as I said, the draft publication and the proposed regulations don't exactly match the statute. So people are just taking a stab at the dark when there's a gap, when there's an A and a B, and we weren't told by Congress or Treasury if it's supposed to be A or supposed to be B. You got some people picking A and some people picking B, and that's why you're coming up with different numbers. So that's why I'm assuming, even though there are huge penalties for getting this math wrong, they're going to have to sort of just not enforce that until they come up with better rules. And then rental real estate. Here's the biggest thing on 199A that's going to burn people.
So this is specifically for people that own real estate, or what exact role is this person playing?
Real estate investors.
Real estate investors. All right. So this is people buying and flipping houses, or is it people buy
and hold?
Buy and hold. Okay.
Buy and hold, and having particularly residential rentals.
Okay.
To get the 199A deduction, if you Google it, people everywhere are going to say, "Hey, real estate investors get a 20% deduction on your income, assuming you're profitable." Investors get nothing, because the law and the proposed regs say real estate, trade, or businesses get the deduction. So what that means is your rental properties have to exceed basically passive mom and pop rental investment and rise to the level of a 162 is what the code section is, trade or business. That means it's regular, continuous, you do it for profit. It's basically all you do to earn a living. So what I'm saying is if you have 4 residential doors, one was a house you grew up in that you're renting, and you bought a couple more, you bought one in college and you're renting it. If you've just got 4 or 5 rental properties that are residential and you have a day job and that's just money coming in the bank, don't expect to be able to get this because you're a real estate investor. You don't have a real estate trade or business. Most of the time, to get rental to rise to the level of trade or business, you have to offer what's called substantial services. So you got to be like, you own the apartment complex and the management company. So you're the one making sure that the plumbing gets fixed when there's a problem, or you have to have a real estate license and be doing nothing but this to earn your living. So if you're doing something else, you're going to have a high hurdle to try to get this. But if you Google it, you're going to be convinced that, oh wow, the $10,000 we made off of our rental property last year, I get to take $2,000 off the top. That's not the case. So then final sort of interesting thing this year is there are new due diligence requirements for the refundable tax credits, and there's 4 of them. There's the earned income tax credit, and that's where lower income people are basically given a check for working. The child tax credit, which is basically, if your tax goes to less than 0 because of the child tax credit, they'll cut you a check for the difference. So if you go negative 200 in tax owed, they'll just give you the $200. The additional child tax credit and the American Opportunity Tax Credit, which is the college credit. That's what you get for tuition. They changed the name of it, but it's basically your college tuition credit. So now tax preparers will be penalized if they didn't do enough research to make sure you were able to take that. Because what happened is people would lie about the earned income credit, and wow. And so okay. And this is the scenario that would happen. You have a divorced couple. Well, only one of you is allowed to get it, and that's the person who has the kid living with them more than half the year. But the IRS can't tell that. And so let's say it's spouse X, it's mom and dad, and let's not worry about, just for example purposes, mom has the kid 75% of the year or 51% of the year. They're managing conservator. They get the school address and everything else like that. Dad has the kid 49.9% of the year. So mom's really entitled to the earned income credit and the head of household and everything. But dad files his tax return first and puts the kid's social security number on there. So the IRS pays. And then mom files a tax return who was entitled to it. The IRS probably still pays or now pops them both for an audit. But that's really expensive for the IRS. So the IRS said, hey, instead, I'm going to make the tax preparer interview you and get records from you verifying your ability to take it. So the tax preparer is now going to sit you down and say, hold on, I want school records. I want shot records. I want birth certificates. I want some proof that they're living at your address and for how long they are. I want divorce decrees. I want receipts for the clothing you bought them. And then the tax preparer has to ask you these personal questions and then hold that information for 3 years. Because if the IRS asks the tax preparer and they don't have that information and you took it incorrectly, the tax preparer gets a $520 penalty for each of the 4 credits that they missed. So up to $2,080 per person would they get dinged for it. So they're going to ask you uncomfortable questions when you ask to get your tax return filed. Again, you can't just give them the information and walk away.
So they transferred the responsibility of this tax credit from the person that was submitting the document to the tax preparer?
Yes, that's exactly right, to the tax preparer. To the person who's otherwise saying, look, all I'm doing is taking their information and putting it on the appropriate form. But now they're saying, I'm taking their information, verifying it's right and putting it on the appropriate form. And so don't be surprised, again, if they ask uncomfortable questions, if it costs more because they may never interviewed you, right? You just, again, you emailed your stuff and it went away. And don't be prepared if sometimes you get told no. I mean, tax preparers now should probably tell you, you're not entitled to this credit. I'm not putting it on your tax return. And if you want me to, you got to go somewhere else because I'm not going to get dinged and pay $500 for you.
That's incredible. And how many different moments in time does a tax preparer bear the responsibility for the information that is given to them per the client? Because in this case, I would always imagine it's the client's responsibility.
Sure.
So all of a sudden now you're saying they transfer the responsibility to the tax preparer.
To the tax preparer, that's right. And so forever and always, the general rule was this. Tax preparers had a canned statement on the tax return that said all this information has been reviewed, but not independently audited, and I have no reason to believe it's wrong. So you couldn't lie as a tax preparer. You couldn't say, look, I know that guy has never had the kid because he came in here yesterday and said, I never keep the kid at my house overnight. Yeah, I'm not going to let that guy take the earned income tax credit. So it used to just be if you had no reason to believe they were lying, that the client was lying to the tax preparer didn't really bear any burden unless they took a position that was just grossly inaccurate. But now there's a new situation that says, no, we go beyond that. You don't have to just not believe that they're not lying to you. You have to do some verification that they're not lying to you. Now, they could forge those documents, but the tax preparer would be okay if they had records from the client.
Right, I get your point.
You won't know that you can't tell when somebody's lying to you, but you've got to take the extra step of getting them to do something to independently verify it for you.
Right, I get your point. So they're not asking them to verify the information. They're saying make sure you get the information. If it checks out, go ahead and add it to the tax return. And then if not, make sure you keep that off.
Right, and you don't have to independently verify it, but it still has to pass the sniff test. So if they gave you school records but then told you I made these up, then yeah, you can't use them.
That's incredible.
But yeah, it's a huge deal.
Well, hey, man, thanks so much for tuning in. It's 1:30. I know your time's pretty valuable, kind of valuable. I've got some of your bills, and they seem to be more valuable.
More valuable to me than it is to you.
Yeah, exactly. So, hey, thanks so much for tuning in. Well, I think we'll, if it's all right with you, maybe we could turn this into a weekly or bi-weekly thing.
Yeah, absolutely.
Here in this tax season, I think it's so important. There's so many questions that we had around, either personal stuff or business stuff. And I think next time it'd be really great to start talking about some of the business concepts that I know you work in so heavily, which is, of course, and contracts and negotiations around those topics. Hiring structure is a big one. Structure is a big one. Yeah,
people always think that because you can go to the website and fill out the paperwork, that's the most trivial and easy thing you'll ever do, and they don't realize it's the most complicated and important thing you'll ever do. I mean, you guys know, your family business suffered 7 figures of heartache from doing that wrong.
I think we bought one of the Joint Strike Fighters for the military. Actually, with that tax bill.
Basically, yeah, an F-35 Lightning II.
Sponsored by
Sponsored by the Nadimis.
Yeah, oh my God. That's pretty much it. So, hey, man, thanks a lot for tuning in again. Thanks for the questions that we received by direct message. We're going to post this up inside of our mastermind member portal. And I guess that's it. So thanks a lot, dude. Later.
Yeah. Bye, everybody.